Hello, everyone, and thank you for joining us today. I'm Taylor Combeluzier, a mining analyst with Red Cloud Securities. Today's webinar features Blackrock Silver. The company is focused on advancing its 100% owned Tonopah West project in Tonopah, Nevada. It's one of the highest head grade silver gold projects out there. The company recently released results from a maiden PEA on the project, which I know Andrew will talk about. I recently got back from a site visit down there and was impressed with the jurisdiction, location, and setup for a potential mine. The company also has an option to acquire 100% interest in the Silver Cloud project in northern Nevada. Today, I have with me on the webinar Andrew Pollard, who's the President and Chief Executive Officer at Blackrock. Good to have you with us, Andrew.
Yeah, it's nice to see you made it home in one piece.
Yeah. So the format of today's webinar will be comprised of two parts. In the first, Andrew will give us an update on Blackrock, as well as an outlook on upcoming catalysts. And then in the second part, we'll take your questions live. So please send your questions in using the chat box, and we'll get to as many as we can. I'll note that you can submit them at any time throughout the presentation. So to start, I'll handle the disclosures, and then we'll get into the presentation. So for Blackrock, there may be some forward-looking statements made on this call. I would direct listeners to the cautionary note on page 2 of the company's corporate presentation located on the company's website. For Red Cloud Securities, Inc., I would highlight that this webinar is for information purposes only and should not be considered a solicitation to purchase or sell securities or a recommendation to buy or sell securities. And we note that this call does not take into account the particular situation or needs of individual investors. Participants should rely on their own investigations and seek their own professional advice before investment. Please see our most recent research located on our website for Blackrock specific disclosures. So with that out of the way, I'll turn it over to Andrew to update you on the company and what you have to look forward to.
Awesome. Thank you very much, Taylor. And yeah, we've got a lot to look forward to. We've come out of, I guess, to what a lot of investors might have thought was a period of dormancy, but we've been actively working behind the scenes for a long, long time, putting our head down to advance our understanding of the deposit. And that all culminated about 2 weeks ago with us unveiling our maiden PEA. This PEA comes just 4 years after we stuck our first hole into the ground at Tonopah West, and this will be our third technical report. This is an important one, though, because it actually contextualizes everything we've done so far. I think what's been missing from all of our results to date has been the grasp from the market's perspective of the economic potential of just what we've got our hands on. And what we're showing just 4 years into the project is this is going to be one of the lowest, well, has the potential to be one of the lowest all-in cost silver producers globally when all is said and done. At a head grade of 570 grams per ton, silver equivalent, this is easily the highest head grade project out there amongst the pure developers. The next closest comp would be 55% less in terms of grade. So as all of you know, grade is king, and it gives you a lot of wiggle room. And that's what we've got right here at Tonopah West. So looking forward to taking you through this. We only put this PEA out 2 weeks ago, and what a 2 weeks it's been since. Right after that, the timing was perfect because we were able to go to Beaver Creek, which is one of the best conferences globally within the metal space, because it gives issuers like ours a chance to sit down with not only institutions, but a lot of the corporates, some of the largest silver and gold producers in the world. And we were able to have some very relevant discussions about where the project is and where we think it can go. In addition, some of you might have seen, but Eric Sprott just earlier this week announced that he was going to take an additional $5 million of Blackrock, which was a huge vote of confidence directly following the PEA, and the terms which certainly seemed to capture the market's attention. He paid a slight premium to market, no warrants whatsoever, and 4-month hold. So that was definitely a strong endorsement of Eric. He's seen as one of the world's biggest silver bugs, and this is following his $5 million investment into us in June. He's really doubling down on Blackrock. So things are bode very well. As Taylor mentioned, definitely a lot of forward-looking statements here where we can look forward to what looks like one very robust deposit. So at Tonopah, halfway between Las Vegas and Reno, we've established about 100 million silver equivalent ounces This would be about 48 million silver ounces and 577,000 ounces of gold. Now, our PEA, which we just put out, we used very conservative costs, certainly compared to today's metals prices. The PEA was based on $1,900 gold and $23 silver, and that showed 8.6 million silver equivalent ounces per year at $1,196 all-in costs over just under 8-year mine life. Already showing a really high after-tax internal rate of return of just under 40% at the base case numbers, and a really attractive NPV to CapEx ratio. We're seeing $323 million NPV on a CapEx estimated to be about $178 million, and that includes $22 million in contingencies as well. Now, given the grade, the project makes sense at lower prices for sure. It's not all that sensitive downwards to costs or to lower metals prices, but where things really get interesting here is what happens at higher prices like we're seeing today. At the upside projection we had in there, which still truly trails prevailing prices, we see this project escalate very quickly. At $2,280 gold and $2,760 silver, the after-tax NPV 5 escalates to $495 million, and you'll see the IRR shoot up to 55%. If you're to use today's metals prices, it would be significantly more than that. So this is truly going to be a high-margin operation, and one of the best things about us is that, we're not in a far-flung jurisdiction. We're truly halfway between Vegas and Reno, right off a highway on private land at that, which makes for very straightforward permitting process. One thing to note on this PEA is we actually excluded 12 million ounces from this mine plan, which from our perspective, we've got orphaned right where this mine currently heads off. It's along the exact same vein corridor, about 1 kilometer away. So we've got 3 drill rigs at site as we speak. And really the purpose of this is to do 2 things. One is to connect that 12 million ounces of mineralization across that 1 kilometer stretch of virgin vein corridor. So we think we'll not only add significant new tonnage, but we'll also liberate that pot of gold at the edge of the rainbow. The other thing is this PEA lays out a 2.3-year mine life. So what we're also focused on doing right now is de-risking our ounces through the initial payback period by drilling to M&I through the early years. And we've had about 20 drill holes completed just on the M&I conversion program already. And after about 2 years of not having any results, we're looking to have a torrent coming down the pipeline very quickly. So the Tonopah Silver District, Taylor can attest, this was one of the most consequential discoveries in Nevada mining history. This time 100 years ago, Tonopah was seen as one of the richest places on earth. It was discovered in 1900, about 10 years after the Comstock lode had petered out, and 2/3 of Nevada's population had left seeking riches elsewhere. It was the discovery of Tonopah in 1900 that truly invigorated the state, and it became just a powerhouse, certainly, of domestic gold and silver production. The riches from Tonopah helped finance the rebuilding of San Francisco after the 1906 fire, and the silver from Tonopah was used as part of the Pittman Act, which helped stabilize the Bank of England after the bombings in World War I. There was something from Tonopah, it was called the peace dollar, which the Bank of England helped to peg their currency against during that. So Tonopah's had a very rich history, both domestically and internationally. In just 30 good years, it had, from discovery to when commercial operations shut down, it produced just under 200 million ounces of silver and 2 million ounces of gold. What really stands out from that, though, is the grade. All of that production came from just 7.5 million tons of rock. And I guess that means 2 things. It means it's really high grade, and it means the metallurgy allowed for the old timers not to leave much meat on the bones. In terms of metallurgy, even to this day, what we're sitting on is about as vanilla as you can get. It's just gold, silver, and you process it, you're left with beach sand. It's highly cyanide soluble, which makes for a very straightforward operation in which the PEA leads out. So, from a high level, as I said, $23 silver, $1,900 gold. This is going to be a big producer, 8.6 million silver equivalent ounces per year over just under 8-year mine life. On a silver and gold production, you're looking between 4 to 5 million ounces of silver, depending on the year, and between 53 and 55,000 ounces of gold, depending on the year. But at some of the lowest all-in cash costs in the industry. At 570 head grade, you're, as I said, about 50 to 60% higher than our next closest peer developer comp. And as I said, there's not really much else in our silver equivalents. Our silver grade is 271 grams per ton, and our gold is about 3.34 grams per ton. So that's what you'd be mining once you're in the stope. This is going to be a big deal as it comes to domestic silver production. America last year produced 32 million ounces of silver. So our contribution between 4 to 5 million ounces per year is going to jog the domestic production by 12 to 15% on an average basis. Yeah, so this is the big picture. So if this were to go into production tomorrow, this is how Tonopah West would compare against every major silver mine on the planet today. What you'll see is it's a large-scale producer, but what truly stands out is the margin you're making on the costs. At $11.96 all in, this is projected to be it will be one of the lowest cost mines in operation once we can get it there. So this is the size of the prize. In terms of domestic silver production, it would fall second to only Greens Creek, which is part of Hecla's portfolio. It's currently bigger than Rochester. It's currently bigger than Lucky Friday. So as I said, this will be truly help make America great again. So, before in these presentations, I'd show how we're always undervalued based on an ounce in the ground basis. Now I can show you that we're undervalued based on multiple metrics. This is us on a PNAV basis versus our other peer developers. So what you'll see is, the other really high-grade story that we'd be compared to would be Vizsla, which is trading at 0.52. And at the moment we put out our PEA, we were trading at 0.13. We've since run a fair bit, but we certainly haven't closed that gap entirely. But I think us being able to show that the CapEx versus what you're actually going to realize in terms of economic potential here more than justifies us closing that gap even further. So this is Tonopah today. What you're seeing here is actually US Highway 95 cutting through this really famous historic mining boomtown. Tonopah hasn't seen much action around it in about 90 years since production shut down there, but it is very close to some truly world-class projects like Kinross's Round Mountain Mine, which is 40 miles to the north. And there's a lot of activity all around us with some big bulk tonnage, heap leach operations, which have commanded a lot of attention, and federal permitting, which is quite impressive. We won't have to jump through any federal hoops with what we're doing, but it's certainly nice to see. And we think there's potential for us to be a hub in what could be a tier one spoke of the wheel when all said and done. So that was Tonopah today, and this is what Tonopah looked like in 1901. It was truly horse and buggies. A lot of the old historic mining involved burros as well. So what we're trying to do is bring modern technology, modern understanding to a district that didn't peter out because they certainly ran out of gold and silver. They petered out due to some technical challenges of the day, primarily the reliability of electricity. So Tonopah itself, it was discovered in 1900 from big outcropping veins on the east side of town. And really the town set up where the original mines were. Now, it was thought at the time to be an east-west trending vein corridor. So all of the early mining, all of that early production happened on the east side of town from big outcropping veins. Some big-time mining companies set up shop and just followed the veins underground. And over time, all of the production moved to the westward. So moved to the west. So, you know, the last producing mine in the district was the Victor mine, if I can show it here. There we go. So that was the thickest vein in the district. It was the last producing mine in the district. And really all of that production started on the east and went to the west. So what we're truly doing is picking up at the 24-meter thick vein where they last stopped mining and just following our way west. And what we're showing now is that we've picked up on this vein corridor. Turn this off. And here's what we've drilled out. So Victor, this mine here, they mined it down to around 1,880 feet on 5 different levels. And as they went deeper and deeper, they at one point flooded out the mine. This would have been in the mid-1920s. The town of Tonopah had just gotten electrified, and they decided to use electric water pumps to handle the water. Well, it wasn't all that much water, and the pumps did the job just fine and dandy, except electricity wasn't all that reliable back then. So it would often lead to brownouts and blackouts and cause the mine to flood, which wasn't exactly ideal when you had a whole lot of people 1,880 feet underground. A man by the name of Charles Schwab was the largest shareholder of a company called the Tonopah Extension Mining Company, which had done a lot of consolidation of that district in the mid to late 1910s and early 1920s. And seeing that there was a lot more mine life, he decided to give the company debt to fund heavy-duty generators and water pumps to be built and shipped over in Europe at one of his foundries. By the time those were built and sent across from Europe, the company hadn't been mining for 3 or 4 years. The Great Depression was emerging. Metals prices had tanked, and he ended up calling the note on the company, sending it into receivership. And it just so happens that all of our mineralization is hosted on the patented claim block that the Tonopah Mining Extension Company had. So we're truly the first group to pick up this claim block and bring work to it since it was picked up out of Chapter 11 in 1930. We did this deal in March of 2020 at the bottom of COVID, and really it was a proof of concept that we were looking to prove to the market. That proof of concept was, to show everyone that, if the records held up, where they left off on this world famous vein corridor, there was a lot more life left to give. And our first drill hole hit 30 meters of a kilogram per ton right in this area. And we've now drilled out 4 kilometers on this vein corridor along strike with a lot of low-hanging expansion potential left in for everyone. So we've got a 20,000 meter drill program underway. It commenced at the very end of July, and we're waiting for the first assays to come out, and that's going to account for 50 drill holes when all is said and done between the end of July and December. So once they start flowing, they should start flowing quite quickly. Now, in terms of the mine plan, what this PEA envisioned was just the Victor area and the DPB area. It leaves off right at the edge of DPB. Now, what you'll see, the way that we've drilled this out is that we've got 3 different deposits laid out currently in our technical reports, but this isn't truly 3 different deposits. We've got 12 million ounces from the mine plan that we orphaned for the purposes of this PEA because it wouldn't have made sense to include this 1 kilometer of strike across multiple veins, which we'd have to have in there as waste rock. What we're trying to do now is effectively close the gap, bridge the mineralization across this 1 kilometer trend here, not only adding what we think has the potential to show another 30 to 40% more tons and ounces, but also liberating this 12 million ounces out here as well, which we'd incorporate into a new PEA, hopefully some point in the latter half of next year. Now, in addition, I said The other goal of this program is to de-risk through the payback period. We want to convert our inferred ounces to M&I to show that, if we start building this thing, there ain't much risk and it's all going to be upside from there. So we'll have 40 drill holes coming in and drilling this area out. This is called our Bermuda vein down here. Now, we think this is one of the highest grade structures in the industry. If we can de-risk these ounces, we're also hoping to add some additional tons in this area as we look to follow the mineralization near surface and also test some of the other southern extents of that as well. So even the M&I conversion program we see as having a lot of expansion potential as we go. So this is the drill plan for this year that's well underway. As I was saying, the bulk of the drilling in terms of drill holes, just because it's shallower drilling we're doing, is on the M&I conversion program. You'll see we do have some step outs down here as well, which we're looking to do. And then we're looking to also link up that mineralization to the northwest with substantial step out drilling. So this area here has a lot of potential to add tons, grade, and mine life. Really, I guess the one thing that we're really trying to achieve now is the 8-year mine life obviously isn't what we want to see as a standalone project. We want to take this well beyond 10 years, and we think that's wildly achievable on this drilling that we're doing right now. So, to put into context, what an advantage having patented land in Nevada is. What this really means is that there's no federal government oversight in terms of what we're doing in advancing this project. It's truly just state and county level permits, which leads to a very, very streamlined process for us. This isn't something that would take, end up in purgatory for 5 or 10 years. This is something that once we get the initial baseline studies done and submitted to the various local agencies, we'd expect to have a permit within 12 to 14 months upon submission. So, what's nice about the way the project is laid out is that all of our logistics, all of the layout falls on our patented claims, meaning it should be very straightforward. It's a 1,500 ton per day mill that we're envisioning. We don't see the mill size particularly changing, even in light of the upside ounces we're targeting on our drilling over the next few years. What we're really trying to do is just backfill the mine life. So what we're hoping for really is if the CapEx is going to stay roughly the same, but we're able to blow out the MPV and the IRR on the drilling that we're doing now by de-risking or shortening the pre-production timeline and also adding substantial amount of mine life to it, then this becomes truly a standout in the industry moving forward. In terms of metallurgy, as I said, this is about as vanilla as you can possibly get. The old timers did all of that production historically from stamp mills. They just crushed the rock and it was very cyanide soluble. So as I said, you're just left with gold, silver, and beach sand when all is said and done. The recoveries are quite high. We've done another round of metallurgy work, which was incorporated into this PEA. So we're able to see incremental increases in both silver and gold. And that was achieved primarily from just testing different grind sizes. But, at about 96% gold and just under 89% silver, this is something that isn't going to give anyone headaches moving forward. And because there's no other metals incorporated into our equivalents, we don't have to go through any extra steps to process this. This would just be a straightforward Merrill-Crowe operation where you'd end up with effectively a doré that's made at site. So no smelters, no flotation required, which makes for straightforward processing, which means lower cost when all is said and done. Now, I told you we're undervalued based off PNAV, and we're also still undervalued wildly based on our ounce in the ground versus our peers. Now, this is one chart I've had in the deck since we put out our maiden resource about 2 years ago. What we've done is we're showing every large silver project in the world right now that's advanced exploration or developers. We've separated them out by grade. So grade is along the x-axis, and then the ounce in the ground is the y-axis. And, this is one of the reasons why, following our resource last year where we, 2.5 extra ounces, but we didn't see that really move our valuation. It made me think that the market just didn't understand the economic potential. And that was confirmed with a lot of analyst reports that we saw that all were very positive. Every analyst that covers us has a buy, but all of them had wildly different expectations in terms of CapEx, in terms of all-in costs, in terms of production profile. So we thought, okay, if we put their head down and do the hard yards, we can show the market the economic potential of our ounces, because compared to the other two high-grade stories, the market's obviously valuing our ounces as more marginal than theirs. And, we knew that wasn't the case, and that's why we came out with this. And now the market's finally waking up to the fact that this is a very straightforward project. It's going to be wildly robust. It's not going to be overly expensive to develop. We're already looking at a 2-to-1 NPV to CapEx ratio, and we think we've got the potential to add significant years of mine life on the drilling we're doing right now. So the market has woken up. Obviously, Sprott saw that valuation gap himself, and we're starting to capture the attention that we think we deserve. But even though we've run a slight bit, I think as of this morning, we're around 65 cents an ounce. There's still a huge, huge gap to close between us and the other two real high-grade stories here. And, what's nice about going through the yards, the hard yards of actually, putting out a mine plan, there's many different ways to hide the ball with respect to resources. We've always been accused of overly constraining our resources versus how others tend to present theirs. But there's no running around head grade. So right here, it looks as though we're neck and neck with the two other stories in terms of what our grades looks like on a resource. But that's not really the case. When you look at head grades, that's where things really take a big step forward, where other ones face a lot of dilution, whereas we've always taken that dilution up front. So when you're in the stope, our grade actually increases, and our head grade goes up to 570. So as I said, a truly standout grade for the project. Those are the drills turning right now. We had a busy couple weeks. We're expecting to have assays coming through, could be any moment now, where we haven't had a chance to look at them simply because of, we were at Beaver Creek all of last week, and then we've had a financing this week, so we're blacked out. But hopefully the next thing coming off the press, once we get the financing closed, is a lot of drill results. And these will be the first drill results that we've had in about 2 years. And as I said, we're drilling into what we think is the highest head grade structure in the industry, and we've got 40 drill holes there. So the market's finally taking note, and we've got a lot to follow up all this action with nothing but drill results through the end of the year. So with that, I'm happy to open things up to Taylor and any questions you have.
So we'll just press on here. So we'll start with the Q&A portion of the webinar now. Just a reminder to everybody on the line that you can type your questions into the chat box at any time. That said, we have a couple that have come in. I know you're talking about costs at the end, near the end of the presentation. We have one here that says, why is your AISC so low? Are you able to benefit from existing mills being nearby?
That's a great question. I like the accusation that it's low, because I was actually I was thinking we could even try and get it lower. But, we used truly blue chip groups to do this on the metallurgy side, and on the mill design side and process side. We used a group called Kappas and Cassidy, who are world renowned, but certainly in Nevada, they're the go-to guys. That's who Anglo's using for their 15 million ounce deposit, located 2 towns over from us. And really the reason why the CapEx is low is the old adage that grade is king. This is the highest head grade project, in the industry at this point, certainly amongst the developers. And it lines up in terms of head grade very, very well with what we see companies like Silvercrest Mining in terms of head grade, and Mag Silver in terms of head grade. We think we can be right at those levels once we complete our M&I conversion program. So grade is king. And what we're showing is, the mill's not all that expensive. The CapEx isn't all that expensive, even inclusive of the $23 million contingencies. The higher grade deposit you have, as long as the metallurgy isn't complicated, generally the higher the margin operation is going to be. So that's why the highest head grade stores in the industry tend to have the lowest cash costs.
Perfect. Okay, so we got one here. I know you mentioned the recent injection from Eric Sprott for that $5 million financing that he came in on. One here looking at, is the company looking for financing? What kind? Equity, royalty, prepaid, offtake? Maybe just give us an overview of where you sit right now and kind of what the runway looks like.
Yeah, well, you know what our plan moving forward, at least the next, say, 12 months or so, that's laid out. The yellow brick road is quite bright in front of us. And what we're really trying to do right now, as I said, is drill out through the payback period and convert those ounces, de-risk those ounces, and then add significant more mine life by drilling out that 1 kilometer vein corridor and liberating those orphan 12 million ounces, which we think will add quite a few additional years, certainly bringing it through 10 plus years. We're not looking to do any sort of mine style financing at this point. This PEA was done with a pencil, not a pen. Certain things, like as the center of gravity moves up to the northwest, if we keep stepping out to the northwest, we may change where things are laid out from a site logistics perspective, or where the portal goes, for instance. Certainly, if we hit very, very high grade chutes along the way to the northwest, it may change the mining plan in the early years as well. So what we're trying to do really in the next 12 months is just fill in all the gaps, make this one cohesive vein corridor. And that mine plan and those economics would probably be something then we'd start looking at decisions to go underground, for example, and chart the path forward from there. But we're never going to have a period like we have now in front of us where we think we can add ounces quicker and cheaper than what we've got in store. We've got two bookends of mineralization that we're really just drilling in between, where we see huge ounce potential and mine life expansion potential. And the drilling we're doing on the M&I conversion should also be quite fun for everyone, simply because this is the shallowest portion on the property. And this one structure, the Bermuda structure, we think, what you'll be seeing in the stopes when all is said and done will be closer to a kilogram head grade, which would be truly a standout even amongst all producers right now. So we're doing hard yards on that. I think, we're going from not drilling for 2 years to coming out with a lot of drill holes in a very quick period of time. So the next 12 months, we're really well covered, and this money from Eric Sprott gives us even more wiggle room to play with. It'll keep shorts off our back, hopefully keep the predatory hedge funds off our back, forcing us down, thinking we'll need to raise. We're in a good position now to get the drilling we want and add the ounces we want.
Perfect. Okay. And on the, I know the money is barely in the door here, but you have that 20,000 meter drill program going on as you outlined. Have you allocated that additional injection in for how many to bump up the meterage, or is it
for sure? Yeah, no, the bulk of the new money will go towards more expansion drilling. The system's still, completely wide open to the northwest, and part of the 20,000 meters of drilling that we've already budgeted for and was, well bought and paid for, included a couple step outs to the northwest. Now, what we'd like to see is have those step outs hit some really good mineralization, because then we can deploy those funds to keep stepping out to the northwest. And we'd want to, on success of drilling out that 1 kilometer and linking everything up, circle back and tighten up some of the drill spacing along the way too. So, this just gives us a lot more money to play with. More drilling is always better than less drilling, and more ounces are better than less. So we're well positioned to keep moving the ball forward.
Excellent. Yeah, sounds good there. We have a question here. Just wondering how deep the veins are. I know being on site last week, it was interesting for me to see kind of the geology changing on the mineralization, that the shallower stuff and versus the deeper stuff, and how the mineralization is different. So maybe just give the viewers here just
I'll see if I can do a visual representation for you, if I can pull up. Okay, so what's interesting about Tonopah itself is that the old timers thought it was just a straightforward east-west trending vein corridor. They didn't really have any method or madness in terms of what the structural controls of it were. Now, we've proven the concept that it's not truly an east-west trending vein corridor. It's actually controlled largely. It follows the margin of a caldera. So a big blow-off top volcano about 21 million years ago led to a lot of gold and silver being deposited. And what it seemed to do is, let's see if I can turn the whiteboard on, is this red line here is what we see as that margin of a caldera. So all of the veins seem to fall on the inner lip of that caldera margin. And what we're finding through our drilling is that when you're on the lip of the caldera margin like this, the veins tend to be quite shallow in nature, and they also tend to be substantially higher grade in nature. So the Victor vein, for example, this was quite not only a thick vein, but it was a very, very high grade vein. And then as the caldera margin went to the south, the Bermuda veins down here, this is the shallowest area on the property, and that's because it's right on that inner lip of the caldera margin. The stuff, as you go deeper, into the caldera, it becomes a little deeper and deeper. What we're finding, typically in terms of mineralization is the veins in the district all seem to have about a 400-meter payload from top to bottom. So the decline, what I'll do is I'll clear this. Because the shallowest portion on our property is also the highest grade structure on our property, we figured this area here is a great place to start. So this is effectively where the decline's going to go, and the Bermuda vein's the first one you're going to encounter underground. So it's shallow and high grade. And then over the years, the mine plan reaches into here, and then it hits Victor in the latter years. And this area here represents all upside potential. At Victor, as I said, that was a big producer. They had they mined it down to around 400 to 500 meters. It was around 1,880 feet is where they stepped off, and we've now drilled out a substantial amount of ounces below where they stopped mining. So we still haven't found the bottom at Victor. We can't go any deeper from surface because all of the drilling of the project has been from surface. And especially in this area, the last area where there was true mining operations in the district, it's hard to navigate around the workings. If a drill hole goes into one of the old workings, you lose the drill hole. So truly to find how deep the plumbing is at Victor, you have to get underground, which you do later on in the mine life. But we're nowhere near the bottom of that system. Once again, you with these epithermal systems, you'll start realizing you're towards the bottom of that mineralization once you start seeing base metals. And really in that area, there's still a lot more life to give. We're not seeing any evidence of base metals there. So it could be truly a long life area.
Excellent. Okay. I'll put out a final call for questions from the audience here. Maybe while we wait for any last ones to come in.
Just one question just on how deep are the veins. So I guess I got to the bottom. The top, where we're, this mine plan envisions mining to start around 200 to 250 meters below surface. We've got drilling underway, which is testing even slightly nearer surface to that. So hopefully there's potential we can shorten the pre-production timeline there. And then once you're underground, you start mining pretty quickly there. And as it's the highest grade structure that we've encountered yet on the property, that's why payback is so quick once you get going.
Perfect. Okay. And I guess just, while we wait for final questions, the focus obviously being on Tonopah West, do you have any update on Silver Cloud or anything, or?
Yeah, Silver Cloud, we that was the project that got me here, and it's what got Bill Howell, our executive chairman, here as well at the company. That was a project that he once had with Placer Dome in the early 2000s. It's 45 square kilometers, very, very prospective, also very early stage, but it's on one of the highest grade gold belts on the planet. right on trend of the Midas mine, which produced 3 million ounces of 30 gram per ton material, and right also directly on trend of Hollister, which produced about 400,000 ounces at a head grade of like 36 grams per ton. Both systems pointing directly at it, and Silver Cloud representing the donut hole in the middle. That was our flagship early on until we got Tonopah and hit on our first drill hole. Tonopah is where all of our valuation's tied to right now. We're undervalued just based off this. And as our model is what we see as being predictive, and we've got a very clear path of adding ounces quicker and cheaper than I think we'll ever, an opportunity that I don't think we'll have like this ever again, and blow out mine life and our MPV on our next resource and PEA. Tonopah is our focus right now. I'm thinking that, we've hit some really high grades up at Silver Cloud, and I'm thinking that maybe once we finish off with the drilling that we're doing and we're awaiting, study level work for, an updated PEA in the back half of next year, it might make sense to go and try and follow up on that 70 gram gold and 600 gram silver discovery hole we made at Silver Cloud last year. It's the prize up there could be, quite high grade and potentially very big, especially if it's Midas style like we think it is. But everything is quite blind and buried up there, and it takes a bit of puck luck. So we don't need to go on any expensive treasure hunts right now. Tonopah is the flagship, and that's where we see the true potential to re-rate quite quickly based off what we think we've got. But I think next year, maybe next summer, once the drills have done all they can do at Tonopah, may be a good time to see if we can hit some more high-grade stuff and piece together another good discovery up there while we wait for the PEA.
Yeah, it makes sense, and provides a bit of news flow for you when you're waiting for those studies. So makes sense to me. Okay, I don't see any other questions that have come in, so I think we'll wrap it there. I would like to thank Andrew from Blackrock for taking the time to host the webinar today with Red Cloud Securities, and thank you to everybody on the line for tuning in with us.